Dr. B here. Please give it a listen, a watch. Fantastic Deals and Dreams pilot series. I interviewed a lot of folks in the real estate and or business world. I hope you enjoy this episode. Enjoy. Hi everybody, welcome to another edition of the Dr. B Show. I'm here, Dr. B with Fuquan. Fuquan, how are you, sir?
I'm doing great, man. Thanks for having me. I really appreciate
Didn't realize we were in the same state. Probably could have done this in person, but it's all good.
it.
All good. Hey man, let's jump right into it. Tell everyone about yourself.
Well, Fuquan Bilal, I've been investing in real estate for 26 years. I started in 99, left corporate and jumped into real estate full time. Went through the GFC and through the COVID and the dot com boom and crash and all that other stuff. So I have the battle scars to prove it. It's still a learning journey. I love real estate. Right. I started off doing fix and flips, and then I dabbled in some notes. Launched my first real estate fund in 2013. Cycled through a few funds. Raised close to $60 million. I think we're over $60 million now of private capital from mom and pop investors. And today we focus on two verticals, which are fix and flips in 5 counties in North Jersey and multifamily in the Southeast, specifically really middle Georgia. We do a little bit in Birmingham area, but we're predominantly in middle Georgia. And that's pretty much it. We partner with accredited investors to take these deals down. And yeah.
I love that. Yeah, we'll dive into that in a little bit. And we were looking at something in Georgia which didn't pan out, but maybe we should chat outside here, right? So for sure.
Okay.
Now tell me, so you pivoted from corporate to what you're doing now. I couldn't find it, as far as on your LinkedIn at least. So did you go to any schooling or any masterminds? What mentors? How'd you learn this, or did you get lucky?
Yeah, well, I actually, when I got started, I was shadowing a family member around. And, from there, I did a deal and I left corporate at that time. I mean, it wasn't easy. I remember the first 6 months going through the Garden State Parkway with no money for the toll. At that time, the toll was like 35 cents. I mean, that's a long time ago, right?
Long
So,
time ago. Now it's like, I don't know, a few dollars.
$1.50 now. But that's the story. I mean, just shadowing family member, saw some stuff that they were doing, which intrigued me and inspired me to kind of jump into the business. And back then, it was more of an FHA market, early 2001 to then it transitioned to like the no doc loans where you could fog a mirror and get a loan. So, more money was on the street, and that helped me accelerate fast in the business, but it also helped me collapse fast as well because I was, even though I was in the business at that time, probably for like 7 years, I still didn't have enough experience. I didn't grow up with financial literacy when I was young, so it was pretty much learn by doing, if you will. And I made so many mistakes. The best thing that happened to me, though, I think, was failing because it kind of humbled me and really made me understand what the real importance of everything is, right? So you chase money, you're a slave of it, and then eventually, once you get humble, you learn how to become the master of it. So you learn that family is important because pretty much it went quiet at that time, and that's the only thing I had to. It was like COVID, right? When everybody was stuck in the house, you got stuck with your family, you got closer, and everybody felt like they got a chance to slow down. And after COVID, everybody was back out running again, right? Fully energized. So that's kind of what the GFC did to me, kind of helped me reset, go deeper within to identify my why and everything else. So again, I'm grateful for all the mistakes that I made, whether they were financial losses or, just things that I had to learn to move forward.
Yeah, like I talk about it in my new book that came out last month, not to plug myself, but I talk about like how I tried to get something in Memphis, didn't work out. I tried to get something in Florida, didn't work out. I had a limited belief that, and which was holding me back, were able to overcome that. And once I overcame that, it took off like a rocket. So I get it. I totally understand like where you're coming from with losses, whether, from all walks of life, man. Um, so surviving the '08. So tell us about that. Did you lose a lot? Did you gain a lot? Some folks,
I,
there
I,
was a
got- I
lot of
got
stuff.
PTSD, man. I don't like.
I get it.
I'm still, no, I mean it,
Is that
it. It
why it's
was
for the
great, right?
haircut? Is that why the
I mean
haircut?
it's. But actually, I've been sporting the ball here since I was 20, and I
Okay.
just I never like after it was just easy, just shave.
Yeah, shave
I
and
don't
that's
have
it.
to go to the barber shop every week.
Save
I don't
money,
have to
man.
sit hear
Yeah,
the barbershop talk. I
right,
grew up in a single parent household, mom, five kids on welfare, so I didn't have a dad. So I don't even know who the players are. Like I can't tell you
right.
who's the football guy from the 1970s and how many yards he had. Like I don't know any of that. So when
Right.
I used to go to the barbershop, I was like, I'm lost. I don't know what the hell is going on. But anyway, I start cutting my own hair. It saves me money and time. I get to do what I need to do, and I travel a lot, so it works for me. But
Yeah.
as far as 2008, the really interesting thing was I really didn't have the network that I have now, right? So your network is your net worth. I'm pretty sure you guys listened and heard that several times, but it's actually true, right? If and it's a saying that says if you look at the five people around you, and you look at what their net worth is, you are the sum total of that, right? So I was by myself, right? I was a lone soldier, right? I was the guy doing many things, wearing many hats, running all over the place. And I didn't have the network. Like I wasn't going to masterminds. I wasn't going to these real estate groups. I wasn't really in tune with what's happening with the market. And I got my ass handed to me because of that. But after '08, I started to build my resources, started to network, started to go to those RIAs, figure out what the hell was going on, who was shaking and moving, who were the lenders, where was people getting capital from. And at that time, like mitigating whatever I had, transitioning stuff back over, a lot of deed and lose and a whole bunch of stuff. I learned a great deal from that as well. The most important thing to me was that I was able to pay off all my investors without filing bankruptcy. I took the hit. Um, but I still have some of those relationships today. That's the point I was getting to, right? The best thing that I learned from that is the relationships, your network. You never know, right? So, and coming out of that, right, learning self-worth. Of course, financials was not where they need to be. So divorce and all that stuff comes into play once you have the financial hardship and really put me closer to my kids and being a better father. So it was a lot of lessons that I learned that I took away from that. If that wouldn't happen, who knows, where I would be, because I was just running, next door, chasing. So that gave me a chance to step back, look at myself, and decide, why am I doing this again? What's the purpose? And then, back then it was the latest designer, traveling all over to Europe and everything else, driving the latest car or two or three cars leased, but now it's like, shopping at Costco and, you know, being more mindful of the finances and what do they say, Robert Kiyosaki in the game, Rich Dad Poor Dad, no doodads. So, I mean, I got a Garmin watch because I swim, but, no Rolexes and all of that stuff. There's nothing wrong with that if people like that. But,
Sure.
me just focusing on what matters most to me, right? So, I mean, if that's kind of what I got out of the GFC '08.
Ah, love it, love it, love it, love it. Tell us about your organization, NNG. Tell us, I know you do real estate investing like me. Tell us a little bit about your strategy or your strategies and what you look for.
Yeah, so we focus on two verticals today, which is luxury fix and flips. Now, I'll speak on that a little bit. Before COVID, we did a lot of inner city stuff, Newark, Irvington, East Orange. I'm from Newark, New Jersey. So that kind of made me feel good going back to the community, revitalizing those properties, a lot of dilapidated, burned out properties, finishing those, giving people in the community jobs for demo and stuff like that. It was a really good feeling. And then basically, all the way up until COVID, we had to pivot because it became very competitive, right? People were coming in paying 30% of a list, and things just got really competitive, and we had to transition over to higher end properties because we were raising a lot of capital, so we can compete with the builders, we can buy cash. And what I came to find out was the profits were way bigger in houses that were at that time we were selling from 750 to like 1.2, and I was making double, if not, almost three times the amount I was making in the other areas. Like our average profit was like 50,000 on the flip, right? I'm talking about net, not the HGTV numbers. I'm like the real numbers. So,
Yeah, the real
um,
numbers, not the one on
yeah,
TV.
the
Exactly.
real numbers. And then I found like you don't have to worry about people breaking in, stealing stuff. You can have stuff delivered. It's on the front lawn, like in Livingston or Milburn or Short Hills. If you have stuff delivered, it's there for 3 weeks. You can leave it alone. Nobody's going to touch it. But if you're in Irvington and Newark, it's gone an hour later once it get delivered. So this the peace of mind and everything else. I started to transition a portfolio there. And fast forward 4 years from now, that's pretty much all we do. We now buy properties, we'll tear them down, we will rebuild them. We'll offer a homeowner's 10-year warranty. We'll go through that whole process. And that's what one of the verticals. The other one is we used to do a lot of rentals too before COVID in New Jersey, but after COVID, the prices went up 30%. We divested the rental portfolio we had in New Jersey and we started buying anywhere from 40 to 150 units in the Southeast. And that's pretty much what we do today. It's an opportunity for us to continue our impact to low income families, seniors who can't afford a rent bump, and just doing like impact investing, affordable housing.
Got it. And then when you raise your capital, do you have your like go-to investors, or do you mix it up as far as like kind of like what we were seeing or what I saw over the weekend, like a mix of private money, grants, I guess in this case maybe do you like connect with the EDA in certain initiatives or no?
Oh man, you're talking about the capital stack, right?
Yeah, the
So
capital stack.
the
Yes, yep.
capital stack is probably for most people is you have a senior lien holder, whether it's a affordable housing fund that's going to fund the deal, right? Because they have an impact part of their fund also, or a bank that have an impact part where they have to give minorities or certain people money and they just to
Yep.
check the box, we did it. And then you have your mezzanine financing if you are raising bridge debt for short term, and then you have your the rest of the equity, whether it's a pref equity or common equity. So that's pretty much how the capital stack fall. For us now, it's a senior lien, whether it's Fannie Freddie, maybe some mezz funding and pref for common equity. More than likely, we have a few deals where it's just senior lien and us, right? We raise the capital, we filled up the equity, and go from there. We don't really do any syndications. Everything is in a fund.
Okay. Yep.
We don't do one-off syndications, so all capital that investors invest with us are collateralized against the assets we own. Investors just get a pref. Some syndications is a pref plus an equity split. And these days, that equity split is not guaranteed. So, a lot of investors went in for the 2x multiple, the 18 IRR, and they come to find out they only made 8%, which is still good money, right? As long as their principal is protected and
Right.
they made 8%, it's better than can't complain off that, right? Other than, oh, you promised me 18, I only made 8, but you gave me back my principal. They did a good job, right?
Right.
So
Yeah.
that's pretty much where we are today.
Got it. Cool. And then I guess going forward, is that going to be like where you're at now as far as your play, at least for the short term, as far as keep doing the luxury stuff for
Yeah,
sure?
the luxury stuff, we give investors opportunity to partner with us on that. Like we pay at 12%. It's a 2-year lockup. There's no monthly payment. It's all deferred to the end. When we sell the property, they get paid 12% per annum. Our projects usually run between 12 and 18 months. So investors can come in, accredited investors with a little as many as small as $50,000. Our average investor is around, almost $150. So on average. So that's basically what they can do. Come in when we close the property, they get paid.
What made you like work in your backyard, like stay working in Jersey? Because I know
The
like in my case,
relationships, back
yeah,
to those relationships. I mean,
for
I've been
sure.
doing it for 26 years. I know the inspectors, built a big contractor base, a lot of resources. Just relationships are everything, right? So
Yeah.
going out of state, it's not hard to manage out of state because we built the CapEx team out of state. It's a challenge though. If you don't speak the language or the slang, they're gonna try to get over on you, especially if you're a guy coming from up north. They're gonna give it to you. So what I've learned was create relationships with other sponsors like myself down there that are boots on the ground, actually, property management companies, and then work through them to get the deals and source, right? And then once they source and I'm going to the properties and they're seeing me now, I'm creating those relationships with them, with the contractors. And then I know pricing, like the down south price, right? Then I can say, hey, I got another project. Let's do the same price, right? Because it's volume. So that's kind of what I learned to do early on.
Makes sense. Makes sense. Yeah, like in my case, like as I told you off air, right? So yeah, working with Mike in Cincinnati, Ely, shout out to him, and then working with Mike Ely and Tim Best out of the Carolinas. Yeah, boots. We have boots on the ground in both of those states, and they both have their own property management companies. So yeah, I agree with you. Like if I didn't have those relationships, yeah, they would take advantage of a guy of a Mets fan, of a Mets fan from up north. So I get it. I get it. Um, going from a micro to a macro level, right? So I think I just saw the ticker. I haven't even checked the news yet, but I think the rates, the Fed rate is going to be steady, right? So does that impact you at all? Like anything but like the noise from the news as far as rates and all that?
Oh, for sure. I mean, it's this, it's a alternative asset. So it's not in direct correlation with, what's happening with the stock market, but interest rates, yes, it does. Interest rates drive the bus. I mean, it has everything to do with financing. And if you're trying to do, if you, bridge debt right now is expensive. So yeah, the rates have to do with everything. Even though we're doing a ground up project and we're not able to raise all the capital in a short period of time to close, we have to go out to, a bridge lender to get money, and it's expensive. So we constantly watch the 10-year every day, but the interest rates drops the bus.
Got it. What do you have to say to those folks that are on the fence that make excuses, whether it's the interest rate, whether it's inflation, whether it's what's going on overseas? Like,
There's always a way, man.
yeah,
There's always a way. You just got to keep going. People are still buying. Um, in any market, people are still buying. I've never seen a market where people stop buying. People still make things happen. They just become a better negotiator. Every deal is based on terms. If you're able to get good terms and it's a good deal, I don't care if interest rates are 12%. If you get good terms from the seller, or seller financing come into play. Because if a seller want to move a property and they know the market is interest rate sensitive, they're going to adjust their terms accordingly, right? If they want to get rid of the property, they'll negotiate something that is mutually beneficial to both parties. So people just need to learn different skill sets, right? Learn how to convince the seller to do owner financing, learn why it's beneficial for them, what the tax benefit it is, and everything else. And you can do deals, for example, on the multifamily side. It's tough, right, to get a property that's not stabilized and get a rate less than 6%, right? You're going to pay 10, 11%. You're going to pay bridge debt, right? Because they got to make their money, and they're taking a risk, so they're going to charge you, or you got to pay like you weigh. So you on those type of deals with the mom and pops that own those properties for a while, they might be income tax sensitive. You might say, hey, this is a way where you want to pay a bunch of taxes. You become the lender. You lend to an LLC. You do some more financing. I give you a little bit of cash to walk away from the table, but you become the bank. I'll make the payments to you while I put my money in the property, fully stabilize it, and take you out. So I'm going to need you to give me, 6% for 3 years, interest only. Maybe I give you a piece of the action. So when I refi, you get a little kicker. You just got to be creative. That's all.
I love that. I love that. I love that. This is a segue to wrap up. So, what advice would you give folks that are on the fence? They want to get into real estate, but they don't know how.
Why do they want to get in real estate? And then make your why the reason that you become driven to get in, right? Most people is either they're looking for time freedom, more money, and if you do it like your life depend on it, then you will go through the wall. You will go over the wall. You will go around the wall. So there's no excuse. If you really want to do something, you will get it done. You don't want it bad enough if you're on the fence. If you want it bad enough, you'll hop off the fence and you'll run towards it.
I agree. A lot of people make excuses, not the right time, the interest rate, tariffs. I have the money. I don't want
Keep those people away from me.
to.
I don't want to be nowhere near them. Let them stay on the fence.
I agree. Where could people find more information about you if they want to connect with you, if they
For
want
sure.
to invest with you down the road?
Yeah, I'm on social media. You catch me at Facebook, on at Fuquan Bilal, and you can go to my company website and check out what we do, nngcapitalfund.com. If you are a credit investor looking to park some capital, you can schedule a discovery call, like to learn more about your investment strategy and see if any opportunities we have align with your investment thesis.
Fuquan, I enjoyed our conversation. Would love to see you in person at some point soon, but I appreciate our time, man. Thanks for being honest with
Absolutely,
us. Thanks, brother. Fuquan Bilal, everybody.
absolutely.
Hey, Dr. B, hope you enjoyed this limited edition Deals and Dreams pilot. I hope you really enjoyed it. Hope you got some insight. And remember, as Mike Lee would say, you are one big deal away from making it happen. All right, take care.